A few years ago, a Canadian tax dispute involving almost $90 million in tax losses reached the Supreme Court of Canada. The case is Dean's Knight Income Corporation, and it changed how tax planning is being viewed in Canada. Before we go further, my name is Amandeep Singh. I'm a CPA and founder of Cloudiverse CPAs in Burnaby. My work focuses mainly on corporate tax planning for business owners, and this case is one of the clearest examples of how the rules are applied today. The story starts with a company called Forbes Meditech, which later became Dean's Knight. By 2007, the company was struggling financially, but accumulated around $90 million in non-capital losses, along with other tax attributes like scientific research expenditures and investment tax credits. In Canada, these losses and credits are, of course, valuable because they can reduce future tax. But there is an important rule. Section 1115 of the Income Tax Act says that if control of a company changes, those losses cannot be used by new owners unless same or similar business continues. In simple terms, the rule exists to prevent people from just buying companies to use their tax losses. Now, control here has specific meaning. It generally refers to legal control, meaning the ability to elect the majority of the board of directors through voting shares. In this case, the company had losses but no income to use them. So in 2008, a carefully structured plan was created with an investment firm called Matco Capital. The structure was sophisticated. It involved financing arrangements, convertible instruments, contractual restrictions, and eventually a public offering. Matco did not technically acquire majority voting control. So, you see, on paper, the legal test of control was avoided. But in reality, Matco gained significant influence. It could restrict major decisions, guide the direction of the company, and effectively control how the business operated. The company then raised over $100 million through an initial public offering and shifted into an investment business. This was a completely different business from the original one that generated the losses. The new business generated income such as portfolio returns and capital gains. You see, between 2009 and 2012, the company used about $65 million of its historical losses, among other tax attributes, to offset that income. The CRA reassessed and denied those deductions. To understand why, it helps to look at how the law approaches these situations. The courts apply something called the General Anti-Avoidance Rule, or GAR. You can think of GAR like a safety rule. Even if a transaction follows the wording of the law, GAR allows the CRA to step in if the result goes against the purpose of the legislation. The analysis works in 3 steps. First, was there a tax benefit? Second, were the transactions mainly done to achieve that benefit? And third, did the result go against the purpose of the law? In this case, the first 2 steps were very clear. The company obtained a tax benefit and the transactions were structured to achieve that outcome. The real issue was the third step. And this is where the Supreme Court focused. The court looked at the purpose of Section 111, subsection 5. That purpose is to prevent new investors from stepping in to a company and using old losses from different businesses for their own benefit. The court made an important distinction. The rule about control is the mechanism, but the purpose behind the rule is what really matters. Even if the mechanism is technically avoided, the broader purpose still applies. The court found that although legal control was not transferred, Matco achieved what is called functional equivalent of control. It was able to direct the company and fundamentally change its business. The original business was effectively gone. The court described the company as becoming an empty vessel with unused tax deductions. Because of that, the result went against the purpose of the law. So GAR applied, and the deductions were denied. The court also emphasized that this type of analysis is very fact-specific. Not every structure that avoids legal control will be challenged. But when the substance shows a clear shift in ownership, business, and benefit, the risk increases. One of the judges disagreed and said the law should rely more on clear technical rules, but the majority of the court focused on the broader purpose of the legislation. There are also additional rules in tax law designed to prevent this type of planning. For example, certain rules treat rights like options or convertible instruments as control if one of the main purpose is to avoid these loss restriction rules. So even if shares are not actually transferred, the law can still treat it as a change of control in some situations. After these events, the law was further strengthened. A newer rules now looks at situations where there is significant change in ownership, even if full legal control is not transferred. This is often referred to as substantial equity test, and it expands how control is evaluated. There are also new reporting requirements. Certain types of tax planning transactions now need to be reported to the CRA, even if they technically comply with the law. These are called mandatory disclosure rules. If these rules are not followed, or if a transaction is later found to be abusive, there can be significant penalties. All of this reflects a broader shift. The tax environment has become more complex and more closely monitored. The CRA now uses advanced tools and data analytics to identify patterns in tax filings. Courts are focusing more on the intent behind the law and not just wording, and enforcement has become stronger. That said, it is important to stay balanced. Tax planning still works, but the level of risk has changed. There are a few practical lessons here. First, stay updated on the CRA guidance and government commentary. These often signal where the CRA may focus next. Second, the optics of the transactions really matter. Many experienced professionals talk about using a tax nose. If something feels off, even if it looks correct on paper, it's worth paying attention to. Third, avoid relying only on clever technical arguments. A structure can look strong but still fail if it goes against the purpose of the law. And fourth, understand the risk before implementing any tax strategy. Fifth, documentation is critical. Proper valuations, clear agreements, and strong records can make a big impact during a CRA review. Sixth, tax planning should not be treated as a budget exercise. Cutting corners and advice can create much larger problems later. And finally, there's an old saying, pigs get fat, but hogs get slaughtered. Moderate, well-structured planning often works better than aggressive tax planning strategies. At Cloudiverse CPAs in Burnaby, our focus is on helping business owners plan properly and avoid unnecessary risk. You can think of Cloudiverse like Google Maps for tax decisions. We help you choose the safest route so you can reach your financial goals without unexpected CRA issues later. Because in today's environment, tax planning still works, but careful tax planning matters more than ever. Thanks for watching, and I'll see you in my next video. Until then, bye.